If you're just getting into real estate investing or you've been in a while, you've probably seen dozens of different equations in order to value an asset. In today's video, I'm going to go over the 5 most important equations that the most elite investors use in analyzing assets they're about to buy. Forget about what you've heard in the past. These are the ones you need to pay attention to. Stick around. Let's go! Equation number 1 is the debt service coverage ratio. That's a ratio that is really important to lenders. And if you intend to get money from a lender to buy a project, you better make them happy with this ratio. What it means is that the lender wants you to be bringing in more net income than the debt service. If you get in trouble and can't pay the loan and they have to take back the property, they want to make sure there's enough net income to service debt they had on it. And banks don't want to own real estate any longer than they have to. So while they're preparing the property to be sold on the REO market, they don't want to have any hassles not having enough net income to pay the debt. So most lenders want at least a 1.2 or 1.3 debt service coverage ratio. Equation number 2 is one of my all-time favorites. It's the break-even occupancy ratio. What's really cool about the equation is it's basically telling you the minimum occupancy you have to have in your property in order to break even. Essentially, it's a measure of how bad would I have to run this property, or how bad would the market have to get before I start losing money if I don't have enough tenants in place. So if you had a break-even occupancy on a property you're looking at of 80%, that's a pretty good purchase, because the thought that you would run a property so bad that you fell below 80% is highly unlikely. Conversely, I don't care how good the property is or the location, if your break-even occupancy is 95% in order for this to be a profitable endeavor, that's a little shaky. Next equation is the cash-on-cash return, which is for many investors the number 1 most important equation. So if you put $1 million down on the property with closing costs and you had $100,000 in cash flow, which is after expenses and debt, that would be a 10% cash-on-cash return. So the cash-on-cash return is really a return of investment while you own the property. It doesn't take into consideration the sale in the future, it's just while you own the property. In multifamily these days, a minimum 6% cash-on-cash is what most investors go for, and of course 8% cash-on-cash would be gold. Next up is the equity multiple. Equity multiple is just how it sounds. How many multiples of the money you have in the property will you earn back over the life of the property? So again, if you put in $1 million in the beginning of the project, which is your down payment plus all your closing costs, and during the 3 to 5 year hold, let's use that as a scenario, you made back $2 million through cash flows and your sale, then you had a 2.0 equity multiple, or essentially you doubled your equity during the hold of the property. And in multifamily investing, a 2.0 equity multiple is what most investors go through. Obviously, the more above that, the more butter. Now, the length of time in an equity multiple does have a factor. If it took you 20 years to have a 2.0 equity multiple, probably not a good deal. But the fact is, most investors hold an asset on average between 3 and 5 years. And the 5th most important equation is the Mac Daddy of them all, at least in my opinion, which is the IRR, or the internal rate of return. The internal rate of return uses most of the same numbers as the equity multiple, but instead of telling you what the multiple is, the IRR tells you what your annual rate of return was during the entire life of the hold. So from the time you bought it, plus all the cash flows each year, plus what you sold it for and put in your pocket, and it gives you that final calculation of what your per year rate of return was. As you can see below in the actual equation, Excel spreadsheets are the best way to calculate that because a written out equation is too difficult. And Excel, through a function called IRR, will spit out to you what your annual rate of return was during the hold. I like IRR the most because it gives you the entire full picture of your performance during the hold of that property. As someone who has valued thousands of properties over my 20+ year career, plus all the valuations that I get to see from beginning investors to the most elite investors in the world, I can tell you definitively the 5 I just gave you are the most important when you're looking at an asset. Thanks guys for taking another watch. Make sure you give me a subscribe and a like. Hit that notification bell right next to it so you're made aware of my videos each week. See you guys on the next one.